On today's show, I'm talking to Scott Sehon, the founder of Mod4 Finance, an outsourced accounting service and CFO consultancy for B2B tech companies. Welcome to Bootstrapped, the lighter side, the podcast for B2B startup founders wanting to achieve success without giving up ownership or control. This podcast is brought to you by Lighter Capital, the leader in founder-friendly financing for B2B SaaS companies. Learn more at lightercapital.com. I am thrilled to be here today talking to Scott Sehon. Welcome, Scott.
Good evening for me, Melissa, and I guess good morning for you. It's great to be here. Thank you for having me.
You're coming to us from Virginia, is that right?
Yeah, Northern Virginia, just outside of Washington, D.C.
Okay, great. Well, Scott, we have had the great pleasure and privilege of working with you across a couple companies, across a couple of Lighter Capital's portfolio companies, and also we've had a chance to meet you in person several times at our CEO summits, and have just been so impressed with the work you do for companies that goes beyond just bookkeeping, but the fundraising and really almost stepping into co-founder roles at certain times. But I want to back up and talk about your background and how this all started, because you actually started as a founder.
Yeah, sure. So really my journey working in small business accounting and finance started 20 years ago this month. My wife and I were expecting our first child, and we were living in New York City at the time. We did not want to raise a child there, we're just too busy, and we didn't have enough money or resources to do that. So I moved to Philadelphia, and the father of a good friend of mine from college hired me without any experience to help him make sense of a bunch of real estate that he had purchased. Commercial real estate. He had about 15 or 20 tenants at the time and didn't have a handle on the leases or any of the finance. So I joined him as his accounting manager, utility infielder, a baseball analogy, where I just ran around and did everything. And fortunately, in that role, I was able to be set up to be surrounded by really, really great advisors. And I did that for 2 years. We had great CPAs and bankers that knew that I was green and knew very little, and they were very patient with me. So 2 years later, with his son, who was my good friend from college, and his wife, we started a company called Crystal Clear Technologies that did government contracting and procurement services for the Department of Defense, Air Force, and federal government. And we grew that the company's still in business today. We started in 2007, 18 years later, and I was there for about 7 years. Grew it to almost $20 million in 7 years. And over the course of that time, I learned everything from building a finance and accounting team, which I had never done, had a team of 5 people working for me. I went to business school and got a MBA in finance from the University of Florida while I was there. We raised both equity and debt while I was there, things that I didn't know anything about. So I had really, really great advisors, everything from our CPAs and bankers to some of my professors in business school that I could lean on for advice. And then eventually that led me up here to Washington, D.C. Really, for my 12 years here in Washington, D.C., I have had a combination of roles leading finance at B2B SaaS companies, mostly venture-backed, and also running my own consultancy, Mod4 Finance, which I've now been doing for several years.
Yeah. And I know in your career, a couple times you've jumped in where you've said, okay, this is such a promising company, and now they need a CFO full-time. I'm going to sort of mothball my Mod4 Finance and jump into this company full-time and then jump back out. So I guess tell me what the thinking is behind that, and what makes you so excited about a company that you're willing to do that.
Yeah, so the one enormous advantage that I've been able to have advising a number of different companies is that if and when the opportunity comes up to join a company full time, the decision to do so should be almost completely de-risked for me, because I will have had it probably between 6 and 12 months to work with the founding team and the CEO already. So I will need, and I will have established, one, an enormous degree of confidence in the CEO of the company, a lot of confidence in my relationship with them, but most importantly, confidence in the ability of the entire team and the company to grow. I've done this twice now, and to make the decision to as you said, mothball my own company and put some clients on the side. Again, it has to be a calculated risk for me that I'm going to enjoy the people I'm working with, but also that I believe that there is far more upside financially in terms of the equity that I can earn over what will probably be a 2 to 3 year period of working with them than I feel like I would be able to build or earn continuing to operate my own consultancy.
Great. You have had the opportunity to see so many companies, and it's typically 1 to 10 million. I know that's what you're working with now, but in the 15 to 17 companies you've worked with, is that roughly the size?
Yes, I think maybe a $500,000 of revenue is the earliest I've started working with a company, and maybe 3 to 4 million is about the latest that I've stepped in on a consulting basis. I've stepped into
Okay.
larger companies on a full-time basis in the past, but in terms of when I begin working with companies, it's usually between a 500,000 and $2 to $3 million of annual revenue.
One of the things that we've seen at Lighter Capital, as you probably know, we've done over 1,000 rounds of financing, and we will fund companies as early as 200,000 in annual recurring revenue, and up to tens of millions in annual recurring revenue. One of the challenges we have is sometimes we'll get what could be a really good company, and we can't finance them because their financials are just not in order. We can't make sense of them. So we are a big fan of fractional CFOs, because usually, when you're in the early stage, you can't afford to have a full-time CFO, and it's not really necessary. But tell us how companies should think about timing for bringing in a fractional CFO and then a full-time CFO.
When to bring in a fractional CFO? Speaking for B2B SaaS companies, I mean, there are a lot of companies out there, but it's also kind of a narrow niche. But that is primarily who I work with. There are a couple of inflection points. One, I would say, regardless of your revenue size, if you are looking to raise capital, be it equity or non-dilutive capital, and the capital that you're looking to raise is requiring and needs you to have not only historical financials that make sense, but also some projections that make sense. And I'm going to use make sense. I use that term very loosely, but generally what that should look like and what I help clients do is build out their projections for 24 to 36 months on an accrual accounting basis so that they have a full understanding of what their revenue recognition should look like, what their gross margins should look like if they are being recognized and reported properly. Because a lot of times I'll step into businesses, or there are companies out there that are, they may come to Lighter Capital or they're going out to raise money, and they've never handled their books on an accrual basis before. They may have a fantastic business. They could be doing $1 or $2 million of revenue business a year, but if all they've done is do it on a cash basis, those financials can look really, really lumpy on a month-over-month basis. And I don't know of many, if any, lenders that want to see anything other than month-over-month financials to see how the trends look, especially the earlier they are, right?
Right.
So if we're looking at a set of financials where the gross margins are going up and down every single month, 40% one month, 90% the next month, then 60 or 70, those are things that I can pretty quickly help companies correct for. I can help them build out their revenue recognition schedules, right? If they're getting prepaid for their contracts and they get $100,000 this month and they get 15,000 next month and 26,000 the next month, that's going to look really, really rocky. But if we can build out the proper revenue recognition schedule, even going backwards, which isn't too difficult for a lot of companies, we can build that nice, smooth growth picture that a lot of founders kind of intuitively, instinctively know that is happening in their business, but they've never seen before. And most importantly, they've never been able to present before to people who may want to invest in the business. And those are things that investors obviously want to and need to see. They want to see the consistent growth. They want to see consistent gross margins. And depending upon the level of detail we can provide them, in terms of building a financial model, they want to see how money is going to flow through the business. So can we build you a model that starts with marketing qualified leads into sales qualified leads into opportunities into closed deals turn into invoices and AR turning into cash, and then cash turning into paychecks and people's wages within the model. So those are all things that it may sound complex, and trust me, nobody is born knowing how to do this stuff. But in a pretty short amount of time, if a company has decent record keeping, even on a cash basis, these are all things that are very achievable and can be built. It's situational in terms of if and when you want to be raising capital, and I mean, at times even maybe even how much capital, and what are the potential investors that you're talking to? What do they want to see? But most of the things I described and laid out are pretty standard in terms of what you should be expected to present.
When you step in, is it typically the founder who's been running the financials, or are they using an outsourced bookkeeper, or is that all over the map?
In most cases, there is a bookkeeper. It could be it could be an early employee, it could be a kind of an HR generalist, maybe an administrative assistant who's helping out. Sometimes the founder is running the books still, doing all the day-to-day, but 9 times out of 10, it is the founder that is still trying to, at the end of the month, make sense of what the financials are telling the business and trying to pull metrics out of them, create reports, and try to get an understanding of whether or not it was a good month, it was a bad month. And a lot of times when I step in, good or bad is measured by how much cash is in the bank. For so many businesses, that's the case. I've worked with plenty of brilliant founders, many of whom understand completely everything. They know what they need to be doing in terms of the finance and accounting, but there are so many things to do in that role that all they're really doing is monitoring their cash balance,
Yeah.
and they realize it's time to arbitrage their time to bring someone else in who can take care of it and help them kind of upgrade the process.
Okay, Scott, tell us, what is it going to cost me? So I'm a B2B SaaS CEO, founder. I've got 500,000 in revenue. I want to go out and do a debt or a venture round. I really think I need to get my books in order. My company's growing well, but I haven't really been taking care of my financials, and I'm ready to hire an outsourced CFO. What should I look for and expect in terms of hours per week, and how much is this going to cost me?
Yeah, sure. So speaking as obviously just one person in terms of how I price things, and I'm happy to be, fairly transparent about that. Generally, I have a setup fee for my clients, and what that will entail is building out their financial model, which is going to be 24 to 36 month projections based upon a really detailed breakdown of all the variables within their business that I will come to understand through having access to their books, talking to the founder. So building out a financial model that goes 24 to 36 months out, building a KPI dashboard that goes along with it, but then also backfilling it 2 to 3 years, as reliable as the data might be, so that they will have one single document that they can send out that has both historicals and projections, KPIs, all of that. And then part of the setup process also is building them a monthly financial reporting package that will be used at the end of every month. So setup fee, depending upon complexity of the business, is usually between $5,000 and $7,500. Again, depending upon the complexity, size of the business, it usually takes 4 to 6 weeks to get that pulled together. And then what I tell my clients when I'm working with them on a setup is that they're not signing a recurring contract for my services. I try to give them in fact, I always give them a range going into setup, saying, hey, if after setup you want to keep working with me, here is a price range of where I think things might fall. But as we go through the setup phase, I learn a little bit more about the complexity of the business, and I can hone in a little bit more on that. And what I like to try to do is give my clients a sliding scale of cash and equity, right? So some companies may be a little more strapped on cash and be able to pay in equity, and others may want to go more cash and less equity. Again, using very broad ranges. An average client for me on a cash basis for recurring services monthly is in $3,000 to $5,000 range, and equity, usually trying to plan it over an expected 12 to 24 month engagement, could be anywhere from 1/4 of a point up to 3/4 or 1% of the business. Again, those are some rough ranges. There are exceptions to all of those things, but that's generally where I work.
Yeah. Well, that cost structure is incredibly reasonable when you compare it to, bringing in a CFO that has your skill set.
And the proposal that I give, that I give people, and I tell them, I say, if you're shopping for other people, and you should be, just make sure there's a very clearly defined statement of worth. My clients will say that for X amount of dollars every month, you are going to get the following, whatever, 10 things, and
Yeah.
it'll list everything out. You're going to get a monthly reporting package. You're going to get a written narrative about the business. You're going to get a KPI dashboard. You're going to have your books closed. You're going to have reconciliations done. And then there are options priced out that say, okay, anything beyond this we'll talk about, and it can either be priced hourly, or if there is a large scope where they say, Scott, we need to go out and raise capital now, and it's going to involve a lot more of your time, then we sit down and we talk about what that might look like from a cost basis. So, but generally I like to price things, at least for recurring, on a fixed price basis, and not do things hourly.
Okay, great. That's really helpful. Have you, across the companies that you've worked with, seen some common characteristics of ones that are just going to break out? I mean, this is what every VC, the skill that every VC claims to have. But when you look at VC returns, that's maybe not the case. Are there things that you look for when you say, okay, I'm going to take, because I know that you're selective and you're highly sought after. So what do you look for? And do you always look for equity as part of the way you work with these companies?
To answer the beginning part of the question, I mean, the companies that appear like they're really going to break out and be a rocket ship, I've been fortunate enough to work with, I would say, 3 businesses that truly have grown an incredible amount, and I was able to work with them pretty early, joining them around the $3 million revenue size. And all 3 of those businesses at least doubled their size 3 years in a row with very little outside investment. They went 500,000 to $1 million to 2 million, 2 to 2.5, 3, $4 million. And they did that with some angel money. How people define seed and Series A now is kind of,
Right.
nebulous, but several consistent threads I could draw across the 3 companies, and they were all in 3 very different, they were all B2B SaaS companies, but doing very, very different things. One, a founder that even before starting the business had a very, very deep understanding and knowledge of the industry. Most founders should have that before starting a business, but some people sometimes have a great idea without much experience in the area, go right into it. All 3 of these founders had deep industry experience. They were all tireless workers. Sometimes you hear in sports the first one into the gym and the last one to leave every day. Almost all of them were extremely empathetic, built incredible cultures, and led by example at the business. Now, none of those things are financial things. On the finance side, in terms of what did the business actually look like, from a very early stage, they had a provable and scalable marketing conversion model in terms of how they went to market with their product, and that they could define saying, if we put X number of dollars into these channels, that Y dollars of ARR are going to come out the other end, and at least have a defensible thesis around that when they went out to raise venture capital to help accelerate the business.
Yeah. I actually think those 3 points, it'd be interesting to do a study on, successful companies and see if that's the case. So deep industry experience, tireless workers, and empathetic leaders who build a great culture.
Yep.
And did any of them go on to have an exit, or is that still?
Yeah. One in particular that I helped run finance for here in DC, this is from 2014 to 2016. They got acquired for over $100 million by it was a locally grown DC business, and they were acquired by a business here in Washington, DC. It was a pretty big win for the DC community.
Yeah, great. You've done both dilutive and non-dilutive financing. Tell us how you've thought about that, how you have counseled the companies that you've worked with on that. When is the right time, to take in venture, and when is the right time to take in non-dilutive financing?
Yeah, great question. And it piggybacks a little bit on some of the things I mentioned before in terms of one, having a clearly repeatable, scalable sales and marketing engine that at least you've proven out on a small scale. And I'm going to use some broad numbers here, but having net revenue retention of 110% or better, gross margins in the 80-85% range. I'm talking about venture capital right now. And if you're prepared to grow your business, what I say is like a triple double, which is doubling your business 3 years in a row, and being prepared to bring in, if you're the founder, being able to bring in outside advisors, a board of directors, and take dilution. I often say it's a question of math and confidence that the founder has. And I'll give a very quick example using numbers, and this is a real life example. So let's say you're a founder and you still own 75% of the business and you're at $2 million of ARR. So if you have 75%, maybe you've raised a little bit of capital, you've given out, maybe you have a smaller co-founder, you've given out some capital to some early employees. And let's say you can raise $8 million at a $24 million valuation. So you're going to give up 1/3 of the company. So you're going to dilute yourself from 75% owner to 50% owner. If that $8 million can get you a triple double from that $2 million, that means in 3 years, you'll be a $16 million business. And at a 6x multiple, you could have a business that's worth, let's say, $100 million. And so now your 50% stake of that is worth $50 million, right? Now, if you look at the alternative of not raising equity capital, the growth that would have to happen is that without additional capital, you'd have to grow the business to $11 million in 3 years for your 75% share to be worth that same $50 million at a 6x revenue. So it's a confidence and math question where the founder and the founding team have to say, are we more likely to grow from $2 million to $16 million in 3 years with an $8 million investment than we are to grow from $2 million to $10 million without an investment? And I'm talking strictly equity. And when trying to answer that question, if it's a 50-50 proposition, maybe even if it's 60-40 or you're unsure, and at $2 million is still pretty early, that's a great time for founders to look at non-dilutive measures because there are still ways and opportunities to prove out some of their early theses that they have around their sales and marketing model in terms of how they think they can grow their revenue with more capital into the business without having to give up a ton of equity and go down, a multi-year path with a new team. So it's math and it's confidence in terms of what the founder and the team thinks that they can execute against.
So you're looking strictly at the numbers versus the other aspects of taking on venture or dilutive capital, which is you're usually giving up some control.
Oh, well, for sure. I mean, like I mentioned on the equity side in the example that I gave, if you're raising an $8 million round of capital, like you're going to have new person or new people on your board of directors. You're going to be giving up potentially 25% or more of the company. And a lot of times, even just psychologically, flipping from 50% owner to 49% owner, even if on paper the founder still has as much control as they did before, that's a big psychological hurdle to get over. And I've been in situations, one relatively recently, where it was a hurdle. The founder just said, I don't care what we're doing. I'm not going to have a number
less than 50%. Yeah.
Less than 50%. So
yeah, and as you know, well, I've said this several times that it's not necessarily percentage ownership that, especially when it comes to venture rounds, that really describes control. But you could maybe sell 5 or 10% of your company in a venture round, but you've also given potentially board seats. You've given someone a veto on whether you can raise capital in the future, a veto on whether you can sell the company in the future. So it's not about the percentage of ownership necessarily. It's what rights come with that investment.
Yep. Yeah, exactly. Along those lines, I'm sure it's been said many times on the podcast before, but if you have term sheets and you're collecting them, make sure you have good outside counsel to review them and make sure you have a really good understanding on what those rights are. So it's all in the fine print.
And do due diligence on the investors.
Yep.
So the investors do lots of due diligence, but it surprises me how often the investees, the companies, don't really diligence the investors.
Yep. That's right.
And one thing you hear all the time is diligence your investors, choose your investors wisely. But we know the reality of venture funding is it only 1 to 2% of tech companies raise venture funding. And so most companies that go out to try and raise venture funding aren't successful. So it's one thing to say choose your investors wisely, but most companies don't get anybody wanting to invest, and then two, when they do, they don't have a choice. There's maybe only one. So it's nice and very rare to be in the position where you're really selecting your investors.
That's right. Within the last couple of years, I worked with a company that was almost best in class in terms of the market that they were serving and the vertical that they were in. We had easily over 50 different investor calls starting at the top of the funnel, and we ended up with 2 term sheets. And I mean, this
Yeah.
company had amazing, amazing metrics, a great team.
Yeah.
And hey, two was great. At least we had choices, but
Yeah.
it's never an easy process. And then this was in 2023, which
I was
was
going to say the timing was, yeah.
there was never a great or easy time to be raising capital, but it was not raining VC dollars in 2023. But we got through it.
Yeah. Let's get back to the work that you're doing now on a daily basis. When you step into a company, are there any tools or systems that they're using that you just say, oh, great, this is what they put in place. They put it in early. It's going to make my life easier.
Yeah. 100% of the companies that I work with are on QuickBooks. Actually, that's not true. I have one client that is on a really old legacy Microsoft system. I think it was an early version of Sage, but all of my other businesses are on QuickBooks. And that for me, that's not a prerequisite. It's just in the US, who knows, 90% of small businesses are using it. So that makes it very easy for me to get a very, very quick understanding around the level of sophistication or simplicity that exists within the business in terms of their accounting processes. When I at least step into the proposal phase, even when I'm proposing to work with company, I ask for access to their books so I can have a look and understand what has to be done. So that's one thing. Any business that already has a revenue recognition schedule set up usually indicates to me that there is a pretty good understanding of the business and a level of sophistication that already exists. And if there's not one, it doesn't mean the founders aren't sophisticated. Like I said before, most times it just means they're focusing on what they should be
Right.
and how much cash is in the bank. And
Yeah. And selling their product and yeah.
and when I'm talking to prospective clients or even brand new ones, I tell them, I was like, look, there's so many things like there's nothing that you should be embarrassed about, because I'll say things, well, are you doing this or this? And they're saying, no, 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 I'm so sorry, we're not doing that right now. I said, no, like, don't have to apologize. Like, you've built an amazing business. Like, everything you have done, if you've built a $2 million business and you're surviving and sustaining, that means you've done the right thing. Like, if you'd spent 40 hours a month or 20 hours a month trying to figure out a revenue recognition schedule, like, that could have been 2 or 3 clients that you lost. So, like, you've done the right thing.
So QuickBooks, which is what almost all of
Yeah.
our US companies use, and most of our Australian ones are on Xero.
Yeah.
But is there a revenue recognition software that you would recommend?
No, not for businesses that are, I would say, under, and this is going to come with a caveat of customer count,
Yeah.
but businesses that are under a couple $1 million of revenue can and probably should still just be using Excel or Google Sheets, unless they have a bunch of different products with a lot of different triggers that could have revenue recognized in different ways. But in most cases, I'm stepping into a situation where clients are selling products either on an annual basis, And that's pretty easy. You can recognize the revenue over 12 months, or they're selling it on a month-to-month basis, and that's pretty easy. So just knowing when a client started working with you and what the contract dates are, we can pretty easily build a revenue recognition schedule in Excel or
Okay.
but if there is a high volume of clients and it's going to continue to grow, and I'm going to say high number of clients, meaning once you're probably over 250 or 300 customers in which you have contracts that should have period over period revenue recognition done, you should probably begin to think about putting in a revenue recognition piece of software of some kind. And you can start simply, I mean, 11 years ago, there were one or two options in the market. Zuora kind of controlled the market, and that was a really, really difficult system to implement. Now, gosh, even QuickBooks is building some light revenue recognition models that can work, but there are lots of others out there that exist.
Okay, so revenue recognition, accounting. When do you bring in a tool to do forecasting and budgeting?
Still, actually, with all 10 of my clients, and right now my largest client is $8 million a year. I'm still a pretty big believer in Google Sheets and Excel.
Okay. Yeah.
Part of that is, I would say, selfish because I feel like I've built a pretty good template
Mm,
I can take and customize for just about any business that I work
okay.
with that is going to work pretty well for budgeting and reporting, both, everything from having visual dashboards to having pick your date, and your budget versus actuals are going to pop up. Your period over period analysis are going to pop up. Like, I take calls. I shouldn't say I take calls all the time. I probably take one call a quarter from companies out there that are building budgeting and projection software, and they're all fine, but I haven't found anything that has made my eyes jump out of my head so much that I say, yeah, I'm going to advocate that my customers start paying for this and that we do a huge migration over to it.
Okay. One of our partners is a company called Forecaster, and they built software, but it also comes with a person. So it's not just a tool, but you're getting actually some help as well. Okay. I wanted to also just talk about you and your hobbies. So you've done some things that are pretty interesting, and you've also got in the future some plans that are pretty interesting that are outside of your CFO day job. But tell us a little bit about that.
I have a great family. My wife and Bethany and I just celebrated our 20th anniversary a
Oh,
couple months
congratulations.
ago. And we have two lovely kids. We have a sophomore in college and a senior in high school, so they keep us really busy. I love to travel, love to do outdoors things and active things. I was a competitive distance runner in childhood and in college. In 2003, my college roommate and I, after a couple years out of school, after we'd paid off our student loans and had saved up some money, we ran across the United States unsupported, which was a lot of fun. We started in the Atlantic Ocean in New Jersey, and we didn't stop running till we got to the Pacific Ocean in Oregon, other than to sleep and drink beer. That's when we stopped and eat some pizza along the way.
And what did you have on your back during this run? Like what were you carrying with you, or were you meeting friends along the way?
I mean, we pushed a baby jogger, so the three-wheeled
Oh, okay.
strollers that you see moms and dads out with their kids in. We got one of those and we strapped our bags to it, and we took turns every 5 minutes for 5.5 straight months, trading off who pushed the stroller.
Every 5 minutes, and that's where all your stuff was. That's great. Oh, so when you had kids, you probably knew the best stroller to get, because I imagine you would have done a lot of research. What's the best jogger stroller?
That's true, but after having pushed one for 3,000 miles, I didn't ever want to push one again. So I was a reluctant stroller dad with my kids, and I didn't use one very often. But we did the whole trip without spending any money for lodging, so we didn't stay in any hotels or campgrounds. We found places to sleep, people to take us in, or we slept on the side of roads. We slept in pipes underneath highways. We slept behind billboards. We slept all over the place. And we grew big, long beards. And the Tom Hanks characters that always come
Yeah.
up, like, oh, you were Forrest Gump. Like, okay, yes, but we looked more like Tom Hanks did at the end of Castaway, at the end of our run than we looked like Forrest Gump. But yeah.
And how long did it take you, and how many miles a day were you doing?
It was 5.5 months, and we averaged 23, 24 miles a day. So
Wow.
almost a marathon a day for
A marathon a day, and not like Sundays off or.
oh, we took I don't know, we took 10 or 11 days off if we found an interesting place to
Oh, okay.
stop and hang out. Yeah, we didn't run every day. We took a few off days.
Okay.
But yeah, I mean, I always try to marry travel and adventure. My son and I hiked up Mount Kilimanjaro a couple years ago in Africa. That was amazing. An outsourced bookkeeper that I hired off of Upwork a couple years ago, who I ended up building an entire finance team out of, lives in Pakistan. I never knew that, a call on Upwork was going to lead 2 years later to me doing, a food tour of Lahore, Pakistan on the back of a motorcycle. So
Yeah.
just try to stay active and always have something new planned. Right now, my son and I are trying to plan in the summer of 2027 to golf 18 holes of golf in all 50 states in 11 and a half days. So we've been,
I I just can't even get my head around that.
yeah,
Yeah.
so we've been spending a lot of time planning the logistics of that trip. So that'll be,
Yeah. And why 11 days? Like, what was the, because I would have thought, okay, 50 days, one state a day, and
yeah, no. The challenge is how fast do we think we absolutely could possibly do it? In 11 and a half days is the shortest possible time we think it can be accomplished in. So
I can't wait until to hear about that and hear how you did it, because I cannot get my head around how you could, because there's got to be planes involved, right? Lots of planes.
only for Alaska and Hawaii. So, yep.
Oh, really?
Yep.
So you're just driving from, okay, great.
Yeah.
Anyway, well, I think we're going to have to wrap this up, but thank you so much, Scott, not just for the time that you spent today talking about your journey and talking about the importance of having your financials in order, but just for, all the help that you've given entrepreneurs over the last couple decades.
Yeah. Well, thank you so much for the invitation here, and also for having been so including and welcoming of me to your CEO summits over the last couple of years, when at one point I was representing the management team of a portfolio company as the CFO. You still let me come. And then most recently coming in as an advisor to your existing portfolio companies. And it's been a real pleasure and treat to get to meet so many interesting and creative and bright individuals, and to get to travel to some interesting and fun places in the U.S.
Yeah.
So thanks
Our
so
next
much.
one is in Park City.
If you're willing to have me, I would love to. I'll be there.
Absolutely, always. Well, thank you, Scott.
Yeah, thank you so much.
Thanks again to Scott for joining our podcast today. And to learn more about Mod4 Finance, you can visit mod4.finance. That's mod, M-O-D, the number 4.finance. We hope you enjoyed this episode of Bootstrapped, the lighter side. To receive future episodes, subscribe using your favorite podcast platform. And if you enjoy this show, please share it with other fellow founders and entrepreneurs. For more insights, helpful tips, and to learn more about founder-friendly financing options, visit us at lightercapital.com. That's LIGHTERCAPITAL.com.